Let's do a round of introductions. We can start at the end with Ray again. If you all want to introduce yourself, give your name, company you work for, and anything else you want to add.
Hi, everyone. I'm Ray. I lead product and research at Grayscale. We are the world's largest crypto-focused asset manager. I've been there since 2018, and I was lucky enough to get to build the company from when it was 5 human beings to what we are today.
Hi, everyone. I'm Jenna Pilgrim. I'm the head of portfolio growth at CoinFund. I joined CoinFund about 3 years ago to reimagine how VCs help post-investment and make sure that we are actually sort of walking the walk of and talking the talk of what how companies need to be built once they have VC investment, because we take a big portion of ownership in a company, and I think we need to give them back something for that. So I joined CoinFund 3 years ago. Before that, I was a founder myself, a VC-backed founder, worked on a startup for 4 years on intellectual property for digital assets, and I got into the space in 2014.
Hi guys, my name is Gary. I am with Further Ventures. We are an Abu Dhabi-based VC. We both incubate and lead up to Series A of companies primarily doing institutional middleware. So everything from custodian infrastructure, broker-dealer infrastructure, both on the regulated service provision side as well as the actual technology that underpins it.
Yeah, hey, I'm Alpen Sheth. I'm a partner at Borderless Capital. We focus on crypto and blockchain. We invest in equity and in token companies. We've been around since about 2018. Prior to Borderless, I was working on the Libra project, and prior to that was in academia. Yeah, the focus for Borderless is infrastructure in the crypto context, but essentially we're looking at the ones that actually have the ability to scale in a borderless way, geographically, and also that can expand to the mainstream. And that's been the focus for about the way that the team sees founders, and a lot of the people at the company are also previous operators, so that's a lot of what's in the DNA of the team. And we also get pretty involved with the founders and the teams to help them reach product market fit.
And my name's Colton. I'm your moderator today. I'm a partner at Arrington Capital, and we're a Web3 hedge fund, and I do venture investing for them. So the topic of today's panel is how can crypto protocols build sustainably when crypto narratives are constantly rotating? So for the first question, maybe let's talk about like what is a narrative and what's driving the narratives. Is it the KOLs? Is it the VCs? Is it just the price? Or is it something else? Go for it, Jenna.
So I think differently from other cycles, we're really seeing revenue and fees drive narrative. And I think that's a lot healthier. It means that those of us who come from traditional finance understand that things can actually be measured. We have some models that we can run on protocols now. And we never used to be able to explain why protocols were able to grow or why developers wanted to build on them. Many people hold the belief that the best technology will win. And I think we've actually seen that to be not true. The best technology won't win. The best distribution will win. And I think that distribution is really incentivized by what revenue and what protocol fees you can pass on to the user. This whole concept of collective ownership, but also collective earning, is a new concept. It seems kind of like silly and novel, but yeah, that's a real narrative driving forward, I think.
I'm with you. If I don't have to review another pitch deck for a governance token for an RWA protocol, I'll be the happiest person on the planet. But generally seeing whether it's protocol revenue getting shared out to the users or there being actual meaningful value that it can drive, that has to work. It has to be a real business at the end of the day, which, this is great bear market vibes. We actually have to go and make money, which is my favorite actually time to be investing.
Yeah, I think this is a fundamental question. I think it comes from a lot of different directions. So one direction is definitely VCs and investors. they set a longer time horizon for their investment theses and the things that they're looking for. They fundraise based on that, and they look for founders building in those areas. So I think that they do have a pretty critical role. I think the other factor is builders and founders. They can spend years and years. Eventually, once they find an opportunity window, they essentially create a new market or a new space for themselves and for others that come in and compete with them. And that, I think, is the strongest signal for people to be like, okay, this is something to look at, whether it's prediction markets, et cetera. And at the same time, yes, there's a lot of noise. I think about academia a lot. You have a kind of similar problem where people come to fields looking for something to discover, and you can be caught up in like a shiny object kind of syndrome, right? Where you're just like, okay, what is the thing that people are talking about at the moment versus what is the thing that's really valuable? And in academia, of course, you could take like 30, 40 years to address something versus in the world of technology and startups, you don't have a shorter time horizon. But I think we're getting signal from very few places, but I think that right now, what people talked about with revenue is something that, I'm sure we'll talk about it further on, but I think that that's maybe the second factor I would consider.
So I agree. We look at revenue. We look at a lot of metrics, the way traditional investors in financing look at them. I think it's still early. I think in crypto you have pricing has been driven by sentiment and narrative, and product market fit has really lagged. So I think retail still plays a huge role. I think it's okay. I think that's in line with the sort of egalitarian ethos of crypto and how it all got started. It's easy sometimes to dismiss some of these things because it's zeitgeisty, but I think the retail component will always be an important factor.
So it seems like everybody thinks that revenue is a narrative right now, but how much of that is just that we're in a bear market and prices are down, so people need a reason to justify like holding coins in a bear market? Because there's that meme of the intelligent investor being thrown into the trash can that everybody sees on X when prices are going up. And right now prices are down, so people are pulling it out of the trash can. But how do we know that that's not just going to happen again? And are we just following this endless loop that we're in? And we're really just following price rather than actual revenue.
I think we don't know. I think that's one of the things we as an industry continue to try to figure out. Right now when you think about like historically the fat protocol thesis, you think about revenue to L1s, that being the value accrual layer. But over the long term, we don't really know, right? It could not play out that way, right? The infrastructure level layer could become commoditized. So it'll be interesting to see how it plays out in terms of value accrual.
Does anybody on the panel think that L1s actually make money? Can we see a show of hands of people who think that L1s should be valued based off their revenue or something else?
Like today or?
Long-term revenue prospects.
Yeah.
Okay, long-term revenue prospects. Okay, interesting.
Yeah, I think, there's this concept of trade-off between growth and revenue at the early stages. And I don't think it always makes sense to apply that. So the thesis is that at the early stages, you focus on growth and you don't really emphasize as much on revenue because you want to grow engagement or users, or it might be enterprise contracts, things that over time you can monetize. The problem is that if you build something that is going to be commoditized, then whatever you've built up, you can lose because someone else will just take that with slightly different, feature sets. I think that's kind of what we're seeing with a lot of, for example, not to harp on any one part of the ecosystem, but L2s. If you see so many different L2s, they may all have some advantages, disadvantages, or specificities, but there's so much commoditization that after a bunch of retail has gone in and farmed and done whatever it is they wanted to do to use that infrastructure, they moved on because there isn't really enough differentiation. They don't need to be there. And I think that the growth versus the revenue concept makes sense when over time you can actually monetize it and have that stickiness actually hold. So I think we have to be clearer about, as investors, where is there a benefit of making that trade-off in the right direction versus where it might not pay off?
I think many investors really sort of overestimated the multiple that like revenue or growth as a multiple of revenue. I think we significantly overestimated that, and I think we need to give protocols a little bit more room to grow and assign it's not a 10x revenue multiple. It's probably like 100x. It's like probably way more. And so I think that we need to be a little bit more fair to protocols that are trying to disrupt, 100-year-old systems. If we're trying to disrupt 100-year-old systems, yeah, we've been like commercially in crypto for like 10 years or so, if you're being generous. So that's not near enough time, especially if a protocol has come out in the last little while. But I think something that people do get wrong is that like if a protocol had its sort of day in the sun and then it came down again, there's probably no dragging it out of here. Very little possibility of it being dragged out here. And like so much time and money is invested on trying to like drag the protocol back out of the mud. And like I think crypto in general suffers from a very deep sunk cost fallacy. And I think we need to be pretty honest about that.
Well, isn't that just another argument for like price driving everything? Because if your success is based on the token going up in price, then that's not the right multiple. And that's why we've seen a proliferation of stablecoins amongst all kinds of different protocols and people paying fees and paying revenue or like accruing revenue in stablecoins because they don't have to then rely on, okay, well, cool, we might be earning this much in tokens, but the tokens are going to go up and then that's going to be great. But like that's not the case at all.
And we're really the only industry in the world that, because of the way that a lot of protocols were fundraising in the first place, they're protected from the kind of governance that typical venture firms would take in straightening a business out. If you raise hundreds of millions of dollars and you haven't shipped anything for a decade, you probably need to be fired. But that's just something that we kind of have to live with, as an industry.
Yeah, I mean, I think there's something interesting with how VC investment happens in this space, right? So, as many are probably aware, when we make investments, we invest in equity and token in a lot of projects. And what's interesting is that even in projects that we expect to launch tokens, we still hold on to this equity. And I think there's something to really kind of investigate here, because the quality, it's not just about them being quote unquote assets, these tokens. It's like these tokens may or may not be of the same quality. And a lot of the things that you get from owning equity, a lot of the governance, a lot of the institutions that are around some of these types of investments don't exist for tokens. Obviously, what we do see and what we, I think, give a lot of value to, maybe overwhelmingly, is the technical capabilities of tokens, what you can do with them, how they're composable, how they're being used in different ways. But you are trading off certain things that you don't get from the tokens. And I think we have to reevaluate what the real value of those tokens actually are as an asset when you invest in it. And what we're seeing in the market, for instance, it may be where we are in the cycle, there may be a dimension to that, but you have to fight really hard to essentially prove that there's value in that token, right? And especially in a bear market, right? But I mean, I would say going forward, it's going to continue to impact and kind of haunt how people issue these assets, quote unquote assets, because they don't have all the capability and rights and features that equity has traditionally, right?
So I want to go back to something that I think Jenna and Alpen had both talked about. There's something's weird going on with the mic. So there's this idea in crypto that we often use, which is, we're just going to give tokens, we're going to give points, and that's going to cause growth of the protocol. And I want to start with Ray over at the end. How do you look at companies or protocols and determine who's growing organically or who's growing just because people are farming the points, and how do you think about sustainable growth and how to tease that out? Because in crypto, a lot of times it's really hard to tell.
Yeah, it is hard to tell. I think, again, that's the point, is you want to look for revenue, for activity that is not incentive-based or emissions-driven. And I think that when you can see, if you can actually see on chain that something is being used, or for instance, it's pretty obvious where there's certain projects that just spend a ton, like most of their time going out and doing business development deals and basically buying up TVL. I think that's what you're looking for, is that you're looking for on-chain metrics, you're looking for real adoption, growth in those kinds of metrics that is not being bought. That said, again, I think we're early. I think product market fit has lagged price sentiment and narrative. So unfortunately, a lot of times it's easier said than done.
Okay, so Ray thinks all the crypto growth is fake. How about the rest of the panelists?
I think the growth that is volume-based is not necessarily fake. But that said, if we're entering a world where it's not just human beings using all of these different protocols, if you can have your AI agent out farming points for you all day, I think we need to look really hard at like what the earning potential is from each of these different protocols. And if you're earning something by doing something, like one of our portfolio companies, Jensen, has a testnet, and you can earn points on the testnet by spinning up an instance of Jensen and like participating on their network and validating transactions. And actually, you have to like go do something. And I think those that are like action based are definitely useful. But net, like I'm very happy that we're exiting like airdrop season, because I think airdrops were genuinely and are genuinely bribery. And so if you're bribing your users, of course they're going to do that. And we saw that in like the growth of Ton. So like Ton had so much potential, had lots of like farming points. Like the idea of that 1 billion people are using Telegram, they had an awesome opportunity. I think they still do, right? Like they still have 1 billion people using Telegram, right? Like every single time you meet somebody, you say, here's my Telegram. Okay, well if you can have a wallet that is 2 clicks away from the home screen on Telegram, and you can reward users for like doing stuff in there, or like sending gifts to each other, or like sending money to each other on Telegram or whatever, that's great. But if you're allowing people like money from, or points or money or tokens or whatever from just like cookie clickering, like no, because that's an easily programmable thing for you to tell your agent to do.
Well, do you think that like in general, any kind of action-based thing that doesn't cost money, like the value of that goes to zero as AI agents proliferate, right?
Yes, totally.
In many ways, I have a much easier job than you do, because we don't look at anything that really touches retail. And so, I am probably of the agreement that yes, anything that has airdrops and incentives built in, please make it go away at some point in time. Though I'm with you that I think retail will persist definitely forever in this space. I mean, if you're launching a project now and you're kind of in the hundreds of millions of dollars FDV, you have to look out for retail activity, or you're going to have a really bad time. That's why you have the entire meta of listing on perp dexes and Korean dexes, and then getting the spot listing, and that entire process is just there to manage retail sentiment. I give you guys a lot of credit for having to actually deal with that on behalf of the entrepreneurs that are launching functional projects. Our business model is slightly different. We're completely kind of government and institutional, backed, and so all of the companies that we back tend to be in that same vein. And so, when the market goes down, what was it like in October? Slept like a baby. I'm like, oh great, volumes went up on a bunch of our companies. Sounds like we're going to make more revenue this month. But it is a position that puts you in a weird place during bull markets, because you're going to always have a capped upside in terms of what you can do, and it's a business model choice of the GPs of the fund to either pursue that upside or to sleep at night with our government backers.
I'm so happy that you're still sleeping at night. That makes one of us. Alpen?
Yeah, so I think another word like that comes up is durability. So you have a lot of what we're seeing as being kind of episodic or periodic kind of phases of activity / value, and even when it comes to price action and or engagement, etc. And ultimately, it has to work in your favor, as a protocol or as an investor in one of these projects and protocols. But otherwise, what it can do is it can actually erode value. right? So you're basically emitting a lot of the resources of a protocol for something that is not going to last very long, right? And then you end up in a period where you eroded so much value. And it's not just the tokens, it's also the resources and the team energy and their own, whatever's being expended for the team to spend on something that is just not really accruing longer term value, right? So I think when everybody's doing it, it's hard to be the protocol or the project that's not as proactive and aggressive about some of these things. But if you pan out and you have a longer term vision and the founder is clearly committed to what they're building, then they have to play it out like 3, 4, 5 years out and be like, well, is this in the right direction of what I need to be doing, right? We see projects that are clearly doing that, for example, on the hyperliquid side, and then you have a lot of projects that maybe have made the wrong trade-offs. So I think that, of course, retail is critical, and it's a core part of the technology stack, but the protocols have a responsibility for the longer term, I believe.
All right, we only have a few minutes left. Going to try and keep this on schedule. So I want narrative predictions from everybody on the panel. And you can't say revenue. You have to say something else. So what do you think is going to be like the hot narrative or one of the hot narratives at the end of 2026? And we can start over at the other end.
I think it's stuff we're already seeing. I think you're going to see tokenization and RWAs, privacy. I think that we're at the end of 2026, we're still going to be talking about those two things.
I think every project will either be consumer and retail focused, or it will be heavily institutional, right? We'll get this year.
Well, that's
we'll
not
get
an answer.
Okay. So those are the two narratives that I think are going
Yeah,
forward.
no, I'm teasing.
Okay, so
I
there's
get it. Yeah.
Anything that's like mercenary-based yield. So products that like we invested early in a company called Veda, and Veda we think is leading the vaults narrative. We think that all institutions will use stablecoins and they will earn yield on them, and then that poses to disrupt a significant part of the banking system in the next 12 months. And then the other one is speculation, gambling, and prediction markets. I think we are seeing the tokenization of everything, and someone is going to build the Trade Everything app. It's going to be Robinhood or Coinbase or somebody we haven't even heard of, and they're going to explode in growth, and Gen Z are just going to keep betting.
So what's like that middle area that you think is kind of going to get left behind? That's like in between.
Alt L1s.
Alt L1s. Interesting. Okay.
Would love to, especially post the crash in October, cross-venue price discovery and oracles getting a little bit of love, finally, so that we can actually get normalized pricing. I think that's necessary for RWAs to work across venues. Otherwise, we're going to not be able to ship these products. So I think that's going to be core. I am with you. It is remarkably boring payments for institutions. Or pure YOLO. I think anything that pretends to be in the middle, like no one buys that anymore. We're past that.
This actually brings me back to my first InnovateDenver. I think that one of the interesting things that we could talk about with narratives was the metaverse, and how interesting that was as a concept for people to say that property would be in the metaverse and everything would be
Even
valuable.
Zuck got psyoped by that narrative. So.
So I won't say metaverse. I think stable coins and basically things like on-chain FX are going to be extremely important. I think it was kind of covered already. So I think the other side is decentralized AI. I think that it peaked a little too early in this previous cycle, where people put a lot of emphasis on what it could do and how quickly it could perform. And even the idea that you could launch tokens and somehow get that to reflect the value of these technologies that are I think will take a long time to play out. But I believe that AI is a massively transformative technology event happening right now. There are range of narrative-driven things, hype-driven things, but I think what's happening with AI in terms of how it's transforming systems is very consequential. And I think the decentralized component of what whether it's blockchains or other types of verifiability or other types of primitives, will be important. It's just that it will take time for those to play out, and teams really have to be very disciplined about implementing and focusing on that. But I believe that's going to be important.
Amazing. Thank you, everybody, for your time and incredible insights.
Thank
Hopefully
you.
we'll get to do this
Thank you.
again
Thank you.
sometime in the future.